Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. This is one of our special episodes. We're recording live at the U.S. Private Credit Direct Lending Conference, put on by Deal Catalyst and the LSTA. And joining me, welcoming to the show, Brian Garfield at Lincoln International and Esther Halber at S&P. Maybe just for the audience's purposes, Esther, a little bit about yourself, what's your role at S&P, and then Brian, it's the same for you.
So I'm a director on the private market index management team at S&P Dow Jones Indices.
Well, first off, thanks for having us. We're really excited. It's going to be a great conversation. And I'm Brian Garfield. I head up our global portfolio evaluation practice at Lincoln. I've been with the firm for 12 years, been a great run, and really looking forward to talking about what's going on in the private capital markets and the great collaboration we have with S&P.
So the S&P Lincoln Senior Debt Index Series, what is it and why now? Or I think you launched in February, but ultimately why now?
Yeah, so the index is a creation of the partnership that we have with Lincoln International, specifically Brian and his team. And the series is designed to measure the illiquid senior debt facilities, specifically unitranche, first lien, second lien loans made to private equity owned companies in the US and in Europe. So currently we have two indices in the series, one for the US, one for Europe, and we are very happy with this partnership because we believe that S&P Dow Jones Indices is a excellent manager of indices. The Lincoln International team is an excellent valuation company in its own right. And so when we put ourselves together, the two firms together, we really bring an element of these expertise into the partnership. And we're actually working together on expanding this series, so we're not stopping at these two. Our teams are in constant conversation on how we can improve the methodology of these indices, the valuation and the calculation frequency. And for Lincoln's customers and clients, this index is probably familiar because they have managed and calculated this index in the past. And our partnership is about, we took over this data set, we put it on our calculation platform, we put everything behind it that S&P is known for in our governance framework, and we are a calculation agent and the distributor of these indices. And the fact that the Lincoln team has been managing this index really gives us a history for the index series that is very valuable. We have 10 years for the US and 6 years for the European series for now.
Yeah, I mean the clients and just the asset management community, LPs, GPs, everyone wants more transparency. It's the buzzword even at the conference we're at today, and this index is gonna bring that to the market. It's what folks are clamoring for, and what I'm really excited about is where we can go from here and pushing it to not only being produced quarterly, but ultimately eventually monthly, which is only going to bring again that rigor. The other part that I think is fascinating about the index that plays along the transparency line is Lincoln is valuing, we performed 25,000 portfolio company valuations last year. And when we do that, and we are collecting the financial information and the closing deal leverage and the purchase price and all that good stuff. And so it allows us to then take that level of transparency and bring that to the index. We of course do it on an aggregated and anonymized basis, but it is still bringing a lot of color to an area that people are looking for the colors on.
And maybe to answer the second half of the question, the why now? Direct lending has seen a tremendous growth over the past couple of years and is now about 50% of the entire private credit universe. And to maybe provide a little bit more color on the other half, it's very fragmented. So it's the single biggest subcategory of private credit. So we naturally gravitated towards doing something in this space. And thankfully, we found a good partner to do that.
Why hadn't some of this existed till now? Is it lack of willingness from GPs to be transparent? Is the market a bit more fragmented, like you said, other parts of the private credit market? Is there any particular reason why it hadn't come to pass until now?
Well, I believe it's safe to say that a lot of firms are working on this and working towards creating an index. Whoever is looking to have something in this space are probably looking at it. The difficult part is the data availability because there's a lot of opacity, a lot of trust and credibility components in this, and for investors to be able to use a data set, we really wanted to provide that transparency, and especially in the governance framework of an index is what we believe the right approach, and that can give the market the most value and benefits.
Yeah, I mean, I think that the direct lending market has been bringing a lot of transparency on a single asset manager basis for really since its infancy. So they've got an SOI, you see the maturity date, you see what's going on with the pricing level, you see the cost basis, you see a mark-to-market process going on. So there's a lot of transparency that's being brought to the market. What I think the market was looking for is a benchmark. How is asset manager one, how's credit shop one doing relative to something? And we felt prudent to bring that something to the market because that's what folks are looking for. So I think the transparency was there. We're just bringing that benchmarking transparency we're bringing that benchmark, which is going to elevate the transparency and the performance metrics a bit more.
And people have called it a crisis, but in a moment like this and where the market's kind of been, does a benchmark like this become even more important given the questions that are in the market, redemption requests from investors? Now granted, it's been more retail versus institutional, but how much more does something like this help investors, especially when it's been a bit more of a under the microscope the last, say, 6, 10, 12 months?
I think it has always would always bring the same level of information that it is bringing. I think now people are really focused on what that data actually is. And so if you look at where the returns are in the index today, that's really valuable information to the marketplace today, because they're looking to see what the return profile of the market is and how that is faring versus the investments that they have made as the underlying investor. So I think that I would say that it's coming to the market at a good time. We didn't time it that way, in terms of our collaboration, but it's definitely been helpful to the given the current conditions.
I mean, has there been any reticence amongst GPs or market participants saying, hey, we don't want this type of data out there? Or have they been more accepting because the market itself is getting more transparent?
I find that everyone is trying to do the right thing in this space, and if people are looking for a bit more information, I don't think I've not heard anybody that doesn't want to facilitate that, and we're really just acting in that way. And we produce a lot of data at Lincoln, and everyone loves the data that we bring. It's the insight and the perspective that we're bringing, and by partnering with a firm like S&P in terms of the indexing, given their rigor, it's only further elevated the index that we had previously produced, and we're really excited about that.
What's been the reaction from LPs and investors? Because clearly this now gives them more insight, not into their own managers, who they obviously have plenty of insight into, but what does it look like for LPs who might want to look across the market and say, how is the managers we've invested in, or maybe managers that we haven't yet invested in?
Go ahead.
I just wanted to say that we're in the early phases of talking to asset owners, LPs, or different participants in the market. The feedback is overall very positive. It's a very interesting development that when we put out the announcement of the partnership and the indices, we instantly got a lot of incoming inquiries about wanting to learn more about this. So I would say that overall very positive reception so far. The question is always whether it is representative of the portfolio of, for example, an asset owner. And to that, our response is that within the direct lending space, it is representative. So we've got a great data set. And important to note, I don't think we've mentioned it so far, that this is an asset level index, not on a fund level. We're using the valuation through Lincoln's valuation platform, the loan level information to create this index.
How much, practically speaking, can LPs use benchmarks like this to better understand the market, and GPs? I mean, you mentioned asset level. Maybe just tell the audience a little bit more, like, what does that mean?
Yeah, I think it's bringing a lot of clarity into what the average yield is, for example, and what the average return profile is at the asset level to the marketplace. So I'll give you a really good example. So if you look back in time, we've seen a change in the yield profile given two things. Number one, we were at the height of the market. We were seeing deals being done on average at SOFR 600, 575, like in that territory, with a higher SOFR rate. Then you see 3 rate cuts come down and more capital flowing into the space because of the excitement of what was a 13.5%, 14% yield. All that capital flows in. Every new deal that's being brought to market more currently is resulting in competition and spread compression, and so the yield profile starts to change. It goes to something with a 4 handle, 450, 475, with a lower SOFR. So now all of a sudden you're at 8-9% yield. That information is what this index is bringing to the market on a frequent basis, in a timely manner. And so then you can look at your funds that you're invested in as an LP and say, okay, how am I faring against this benchmark? And as was mentioned, like, this is global. And so we're seeing that this data is really representative of what's going on in multiple geographies in the US and in Europe, and I think that it's quite exciting, and we're getting a lot of positive receptivity, particularly in both markets, to understand the yield and return profile of the asset class.
Does it cover upper market, middle market, lower middle market?
It does. The data, because we have the fundamental information, we can cut the information. Well, at a future state, we will be planning to cut the information by size, and you can go to an industry level, and that is really exciting if you think about what you can do with that. And what's going to be fascinating, I think, to the marketplace is that there is a different yield profile by size. There is a different yield profile by industry, and we are fielding questions on, well, what is that? This is going to bring that to the market.
You obviously mentioned in future iterations, like what does this look like in version 2, version 3? I mean, we don't have to get into every little detail, but I believe it's monthly now?
It is quarterly.
Or quarterly now, then it's supposed to go monthly. Is the hope that eventually it becomes daily?
I think the industry might be a little bit further away from being able to do the daily, at least in a methodology that we believe is the right one to calculate an index like this. But we're doing quarterly, we're actively working on the monthly calculation, and then with that, the valuation of these assets. And as Brian mentioned, we're working on those different cuts and continuously evolving the methodology of the data set as well. Another element of that is the analytics that through the data set we have access to, and we want to do something with that and bring that to the market. Maybe Brian, you can touch on the different metrics that we have.
Yeah, I mean, for example, knowing the LTV profile or the leverage profile of the specific size category that one might choose, or the industry that they choose, and then taking that profile, putting it up against what they're invested in, or up against another industry and another size profile, and comparing that is going to be a really powerful tool, and it's going to be the only index that can do that. So we're really excited. And then, on the daily point, it's really just a function of where the market goes. So as the market moves more daily, then we will be able to get into that daily cadence. Where the market has moved is to monthly. Where it is moving is to daily. So we will basically keep up with that pace, because what often happens is that when a fund moves to daily, we get a phone call, we get excited at Lincoln because we end up kind of working with that fund on a daily valuation process.
We've heard it on panels today, and from what you're telling me, it certainly sounds that way, that some of the private markets are starting to look like public markets, especially from a transparency point of view. Is that a good thing? Will some of the premium that obviously people are looking for in private markets, will that erode if they look closer like public markets?
I don't think the premium is going to go away. These are still illiquid assets. They're still buy and hold positions. I think when you think about the structure of funds that might be created to get access downstream, that may, that will have a higher volume of production of what the unit price is. But I still think you're going to find, and you see this today, that there is a premium between public to private, and that a liquidity premium is a function of the type of deal that's being structured. These deals are very bilateral in nature between a sponsor and a lender, and that type of a deal will be a premium relative to, let's say, a BSL market, which is more syndicated public deal.
Is there a concern that if we go into, say, a protracted downturn, that there would then be a reticence to share some of this data?
No.
That's a good thing.
No, I don't think so. I think, I go back to the point that I made earlier. I find that the asset managers are looking to bring clarity to the space. They are looking to answer questions that investors have. We feel that they're engaging firms like Lincoln in order to bring that level of transparency to the market and accuracy to the valuation process by having a third party like Lincoln in place. So I think that they'll be open to continuing to bring the transparency that they're currently bringing now.
Are we in a healthier environment with benchmarks like this, and obviously more analytics, more data today than, say, 3, 4, 5 years ago?
I think we're just in a more transparent ecosystem. When you look at the quality of the portfolio companies that are being held by the direct lending space, and even more generally the sponsor-backed community, you find that we are continue to see deals that are growing, both on a revenue and EBITDA basis. The percentage of deals that are growing on a revenue basis and an EBITDA basis is greater than 50%. We have seen that for a long time now. Positive EBITDA growth, positive revenue growth on average. So when you look at the underlying health of the private capital markets, you see a very healthy market. And yes, there's certainly been additional PIK usage, but that's only 10% on an instance basis, which means 90% of deals are paying cash interest. So in terms of what this is all doing, in terms of our partnership, it's bringing transparency to a marketplace that didn't have a benchmark before. But in terms of the asset quality really is different than what we're doing. And healthy at that, like I said.
Yeah. What about the non-sponsor backed? Is there a plan to eventually move into covering those within a benchmark like this? Or is it primarily sticking with sponsor backed? I mean, what percentage of that of the market is non-sponsor backed today?
It's mostly sponsor backed. I mean, I
wouldn't make sense.
I could speak to the data that we have. Like 99% of everything we value is sponsor backed.
Yeah.
And so that kind of gives you a feel for, that should give you a general size, because we work with well over 250 asset managers, so it should give you a general framework.
Does, part of the conversation today, clearly with the retail issues, does a benchmark like this help bring more democratization to private credit?
Yeah, I think democratization will help the adoption, because a benchmark will help users tell a better story, a more pronounced narrative around the space, the investments, how they work in different market environments. And I think the retail space, historically, if I think about not the private markets, but the public market segment of the retail space, those conversations are mostly built on storytelling.
Well, I was just about, you took the word right out of my head, which is someone's telling them a story. And now, with benchmarks like this, they can at least look and see whether or not the story's true.
And there's a reference point.
Yeah. Interesting. Is the cascading impacts of retail, which has obviously been talked about a lot today in the conversations, is there a worry that more democratization, more retail brings more haziness to this space? Or because the one thing I think everyone's been clear on is institutional money is not shying away from this space at all. Obviously the retail money is, part of that relates to the storytelling. But is democratization a good thing for private credit, long term?
My take would be yes. The more information each participant have, the better decisions they can make, the better they can understand if they are willing to take on that exposure. And I think for the industry to evolve further, whether it's on the data side or the product creation side or the liquidity management side, everybody needs to work together to solve the problems together, because it's an ecosystem like other parts of private markets, in my opinion.
Yeah, the private capital markets are an area that is an investable opportunity. And so what is happening is that you're giving that investable opportunity to a greater pool of people.
Yeah.
And so there's an education that goes with, what am I investing in? And I think we're going through that process right now. What is this product, and how does this, what is this, a buy and hold strategy? How do I get out of this? Can I get out of this? And we're going through that evolution of the process right now. So I do not think that the private capital markets are going to be ignored going forward by just any investor. I think it's going to be a very common conversation. It's going to be something that is ultimately going to be in a 401k account, as we all know, and so that is going to lend itself to everyone wanting to get access to it in some way, shape, or form. And I think having a benchmark like we produced is going to be really important. Having good governance in the valuation process is also going to be equally important in that process.
And it speaks to the credibility element that we mentioned earlier, because when you think about public markets, even if you don't know what you're investing in, that makes it really difficult for retail to pick it up. But when ETFs were introduced, suddenly it was much easier to have a better granular view of the market and see what's happening there. So I think private markets might be going in that direction, and an important building block will be benchmarks, or benchmarks. I shouldn't speak in the future because we're living it.
Is there a final question before a couple of maybe forward-looking questions? Is there a concern, if there's other benchmarks created, like does it create confusion amongst investors, or is just, there might be a favorite benchmark for someone, but more transparency, more data?
The favorite benchmark will be our benchmark.
Obviously.
Just to clarify.
Yes. But, is there a concern if there's different benchmarks? Do people, are they looking at different things?
I think it comes down to the construction of that benchmark. As I mentioned, our benchmark has a long history, and so it is differentiated from others that have been launched before us. So in my opinion, it will come down to what the end user needs, but certainly longer history is preferable, asset level is preferable.
Yeah, I think it's just important that, like when we put out our index, for example, that we're just clear about what it is, what's in it, what is the rigor behind the calculation, how often is it produced. I think when you have that information, then you can start drawing comparisons to something else.
Yeah.
And I think our goal is to bring that information forward. This way people can draw that comp.
If we look ahead, how different do you think private credit looks, say 3 or 4 or 5 years from now versus where we are today? Is it more concentrated at the top? Today's crisis in more of a blip? Where do you think we're headed in the space?
So I don't think we're in a crisis right now. I think that if you look at the...
I've been trying to use the air quotes to...
Yeah, I think we're in a crisis then. I'll clarify the way I answer. So I think we're just in because if I look at the fundamental performance, that's why I'm saying that. I look at the fundamental performance like I talked about earlier about the growth, and what's happening now, and there's a shift that's going on too in we're going to start to see spreads wider, and that's going to help the asset class from a return perspective.
Yeah.
And so I think that's a positive for the asset class too. So, I think we're just going through a cycle, like a moment in time where we're going to kind of come out of it with with wider spreads, which again will be beneficial on the yield side. So, as we kind of project forward how the private credit is a very loosely used term in the first place. So the direct lending portion, I think there will be continuation of additional retail. I think you're going to see more funds that come out that are reporting on a monthly basis. I see that all, I expect that all to happen. I expect it to eventually be funds where there'll be daily products on them. And right now we have daily we're doing valuations for funds that are done on a daily basis. And I think you're going to see the types of asset classes across that private credit space only further expand, whether that be asset-backed finance, whether that be private placement, further, additional investment grade. I mean, there's a big spectrum here, and I think the capital is going to move throughout that spectrum. So I think we're only in the since it's baseball season, we're in the very early innings of the private credit expansion effort.
This one's probably harder to answer, but is there...
Well, Esther can answer.
What's the biggest unlock that hasn't yet happened in the market?
That's a tough one, for sure. Maybe I would say the full retail expansion, really solving for the liquidity management part of liquidity in and then liquidity out, right? Specifically, because those can look very different.
It feels like we're in more of an education crisis than anything else.
Absolutely, yeah. Maybe not crisis, but there's definitely, we're definitely in the education phase. I would say institutional investors were in that phase a couple of years ago. And now we're adding the retail space in there, who usually don't have that same level of sophistication or the same amount of staff or support system that can help them really look into the data and understand what's going on under the hood. And then you add the illiquid and opaque nature of private markets on top of that. So I guess not to repeat myself too much, but a benchmark is really what's gonna move the needle here when we can look at the direct lending as an industry from the top down.
So we'd like to end with a little bit more lighter, funner questions.
That's good.
Favorite sports team and or hobby? Esther first.
Ooh, I'm a massive Formula One fan, actually.
Okay.
So
I wouldn't have guessed that. That's a good fun fact.
It is a fun fact, and I like the series as a whole. So I don't necessarily have a favorite team, but if I were to say one, maybe Ferrari.
So for better or worse, I'm going to admit it on your podcast, which I'm sure has millions and millions of viewers, that I am a New York Mets fan. And I know for all your viewers, you're very sorry for me, but I'm a huge New York Mets fan, and hopefully they'll pull it out. They're on a big losing streak right now.
I'm with you, and it's not been fun.
It's not been fun at all.
One surprising thing about yourself, this time you start.
One surprising thing about myself, tough one. One surprising thing about myself is that I'm an avid reader.
Okay. Esther, what about you?
Continuing on the previous one, a fun fact, or again, surprising thing about me is that I was actually part of a racing team on a student level. So when I was at university.
Oh, wow. We should have a separate podcast on this. This is way interesting that I read books.
Yeah, so student team, naturally I was in charge of getting the money for the team to be able to build a race car, but we actually took it all over Europe and raced it.
One book you'd recommend reading?
I am Hungarian, so for me the most beautiful and poetic language is Hungarian. So I would recommend everyone to read The Door by Magda Szabó. And I know it's widely distributed in the US and it's translated, so that would be my recommendation.
Avid reader, favorite book?
Avid reader, New York Mets fan. I guess I would say the book that I like to read the most is the one that my favorite player, David Wright, wrote about himself, because it was just fascinating, the commitment and work ethic that he had to kind of get to where he was. And if he's watching, I've always wanted to meet you, so figure out a way to make that happen.
Fun fact about me, I interviewed him for my college news station.
Oh, wow, look at that. So you could hook it up.
Yeah, I don't actually have a connection to him, but they did like a charity event at a children's hospital, and we covered it when I was at college, and he happened to be one of the people. It was him, Steve Traxel, and I think one or two others, and so I actually interviewed David Wright on camera.
Oh, wow, that's really cool. I'm very jealous now.
Most exciting part of your job?
The most exciting part of my job is working with really high-performing professionals. I really love it when I see an analyst come in and they get promoted to an associate, they get promoted to VP, and a few of my partners today were an analyst when I started, and so that is super rewarding, and looking forward to seeing more of that happen in my group.
That's amazing. For me, is to not only be able to meet with very interesting clients and individuals, but actually partner with them, such as Brian and his team, amazing individuals. But we take a very specific approach when it comes to our clients. We would like to think with them through the problems that they want to solve. So it makes for very, very interesting product creation conversations, and it's really amazing to be able to provide those solutions to them.
I'll put you on the spot for the last question. One prediction for the next 12 months. All right?
Yeah, I think across the private capital markets, we're going to start to see, essentially, I would call it a K-shape forming, and form more clearly, where there's going to be a lot of winners, and there's going to be some losers that come out of it. And I think that shape over the next 12 months is going to form. And I think that right now we're seeing a lot of health in the private capital markets, so it's very well possible that top end of the K will be overweighted. But that being said, I think it's going to become more clear over the next 12 months.
It's a good way to end it. Ryan, thank you much. Esther, thank you very much.
Thank you.
Thank
for
you.
having
And
us.
thank you to the audience for listening.
Thank you.
All right.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.